All right, welcome to The Explainer. Today we're going to take a look at the market, but from a bit of a different angle. We're digging into some signals that might be telling a completely different story than the one you're hearing in all the headlines. So let's just get right into it. Every time you look at your phone, every headline, it just screams crisis, right? But is all this panic we're feeling actually backed up by the hard data? Or is there something else going on just beneath the surface? We're going to peel back those layers and see what the markets themselves are actually telling us. And look, it's totally understandable why everyone's so anxious. I mean, these are the topics that are just dominating the conversation. They paint this picture of a global economy that's right on the brink. And that constant drumbeat of negative news, it creates this powerful story of impending doom that's, well, it's really hard to ignore. But what if this intense focus on the rising cost of everything is actually distracting us? What if we're all looking at the wrong problem, while a much bigger, much quieter one is growing right under our noses? Okay, this is where it gets really interesting. We're all trained to watch price inflation, right? We feel it every single day, at the grocery store, at the gas pump. But monetary degradation, that's the hidden problem. It's the slow, steady erosion of our currency's value because of massive public debt. Think of it like a bucket with a slow leak. The government keeps pouring more water in, but the hole from all that debt just keeps getting bigger, and the real value is slowly draining away. The data is hinting that this hidden problem might just be the real story. And hey, don't just take my word for it. This isn't some fringe theory we're talking about. This is a direct warning from the chairman of the Federal Reserve himself. When the guy in charge of the money says the foundation is under stress, you should probably listen. He's not mincing words here. He's saying point blank that the debt is growing way faster than our ability to pay for it. And his conclusion is pretty chilling. If something doesn't change, this will not end well. That's a huge challenge to the long-term stability we all kind of take for granted. So with that pretty serious long-term picture in our minds, let's circle back to the visible problem, the one that has everyone so worried right now, inflation. What are the markets, the ones with real money on the line, actually thinking is going to happen? 2.57%. This one number tells such a powerful story. This is what the bond market is predicting for the average inflation rate over the next 5 years. So despite all the panic and the high prices we're seeing today, the long-term view is surprisingly calm. So here's the key takeaway, right? The market is clearly seeing two different timelines. In the short term, yeah, things are going to be a little hot, probably around 3% inflation for the next year. But look further out, and the expectation is that things totally normalize. The financial markets are placing massive bets that this painful spike in inflation is, in fact, a temporary problem. And you know what? We see this exact same pattern, the split between short-term panic and underlying stability, when we look at one of the biggest drivers of fear out there, the price of oil. This chart just lays it out perfectly. Check it out. Back at the peak of the Ukraine crisis, oil hit $120 a barrel, and you can see those long-term inflation fears shot up to 3.5%. Now, today, oil is still high, no doubt about it, but it's lower. And more importantly, look at the inflation expectation. It's a full percentage point lower. The market is just not panicking in the same way it was before. Okay, let's get a little nerdy for a second because this is cool. If you dig into the market's internal plumbing, you find this. The price difference, or spread, between international Brent crude and US WTI crude, it's a huge tell about supply stress. A big spread means there are traffic jams and bottlenecks in the system. A smaller spread means things are flowing smoothly. And right now, that spread is telling us the bottlenecks are actually easing, not getting worse. That suggests what we're seeing is driven more by scary headlines than a real breakdown in supply. All right, now for what might be the biggest signal of all. Let's turn to the stock market, because right now it is flashing one of the most powerful contrarian signals we have seen in a long, long time. To put it really simply, people are scared. I mean, really scared. And we can actually measure that fear by looking at the amount of money betting on the market to go down. And that measure has hit a historic high. Now that sounds terrifying, but as any seasoned investor will tell you, when fear hits a fever pitch like this, it often means the worst is already over. Now just look at this chart. Seriously, that bar on the left, that shows the level of bets against small cap stocks back in October 2022. And the bar on the right, that's today. They are identical. The level of pessimism right now is at the same extreme high that we saw then. And what happened right after that last peak in fear? You guessed it, that marks the exact market bottom before a massive rally. And this isn't just happening in one little corner of the market. It's everywhere. We're seeing a huge spike in demand for protective put options on the S&P 500. That's basically people buying insurance against a crash. But then you get this really weird one, a massive, and I mean massive, spike in bets against the energy sector. That seems totally backwards, doesn't it? This is a real head scratcher. Why on earth would you bet against the best performing sector in the entire market? It kind of makes no sense. Or does it? There are a couple of possibilities. One is that investors think all the good news is already baked in. But the other, more interesting idea is that maybe, just maybe, they're positioning for a swift, unexpected end to the conflict that's been driving prices so high. So let's put all these pieces of the puzzle together. You've got long-term inflation fears that seem to be cooling off. You've got the internal plumbing of the oil market telling us that supply is easing. And then you have the stock market, just absolutely gripped by a level of fear we've only seen at major turning points. It all points to one critical question. The data strongly suggests that the ingredients for a powerful, sharp rally are quietly coming together, right under the surface of all this panic. Now, this isn't about having a crystal ball, but it is about understanding the conditions. And right now, the conditions suggest the real question isn't if a rebound will happen, but being prepared for the opportunities when it does.